Okay, good evening. It is just before 9 o'clock on a Thursday evening, Eastern Standard Time. So I figured I'd come to you with some scary stories before bedtime about real estate investing, specifically return on investment or ROI. So if you have any questions about real estate investing or return on investment, or if you think I just really suck at telling bedtime stories, head on over to callseth.com and we can set up a quick 20 or 30-minute Zoom call face-to-face, and we can learn more about your real estate goals. So the scary truth about ROI and why return on investment matters. And I was actually thinking about this after a video I did last week on why you should not pay off your mortgage. So many people out there, it's almost like common consensus that everybody thinks that debt is bad, you should pay off your mortgage, and I explained why you really shouldn't and why the most successful people don't even care about paying off their mortgage. So this is almost like a spin-off off of that video. I don't want to repeat myself, but I did want to talk about something called the Rule of 72. And the Rule of 72 is really important when you're looking at return on investment, especially in real estate investing, but this applies to any sort of investment. And what the Rule of 72 does is it lets you know how long it's going to take for your capital to double based on the return you are earning. So all you do is you take 72, it's almost self-explanatory in the name, the Rule of 72. So you take 72 and you divide it by the rate of return you're receiving, and that's going to tell you how long it's going to take for your your capital to double. And I'm going to use a couple examples that almost fit in to the last video I did about paying off your mortgage, because the reason is, and this drives me nuts. So many people think they have to pay off the mortgage. And right now with the residential property, most people are paying, let's say 3 to 4% on the residential mortgage. And they put so much time and effort into paying off this mortgage because they think that debt is bad. They don't want to pay the bank any extra money. But the thing is, they're slaving away, putting every extra dollar into this mortgage to pay it off. But when the money gets into the equity of the home, it's not paying them a return. Plus, there's a lot better ways that you can use this money. So why would you slave away and pay off 3 or 4% when there are investments, especially in real estate, that pay you in excess of 10%, sometimes in excess of 20%. It doesn't make sense to me. And excuse me if I get fired up a little bit, because this is something I'm very, very passionate about. So if you think I'm getting too fired up, head over to callseth.com and we can chat about it. And I may drop some F-bombs along the way. So the Rule of 72. So let's say, let's pick an investment. So let's say I'm earning 1% a year. So this is like me keeping my money in the bank, which you should never do, even though common consensus, common knowledge says, oh, you should save your money in the bank. That's a prudent thing to do. Well, your money goes to the bank to die because inflation is way more than 1%. And I know lots of banks that are paying you less than 1% to give them the pleasure of using your money, and the bank will actually take your money, go off and make some pretty healthy returns on it. So using the Rule of 72, so 72 divided by 1 gives you 72 years. Are you kidding me? It's going to take 72 years. That's a lifetime. Well, for some people, that's most of a lifetime for others. It's going to take 72 years for your capital to double if you keep it in the bank. But why do so many people keep their money in the bank if it's going to take an entire lifetime for it to double? That's just so crazy, especially when there are so many other investments out there that are paying a much better return, and not to mention all the tax benefits and all that stuff that comes along with real estate investing. This is where things get really, really scary. So let's say 6%. So this could be a mutual fund. So again, we take 72 and we divide it by 6, and that's going to give us 12 years. More than a decade. Are you kidding me? I'm just getting so fired up. So it's going to take 12 years for my capital to double. Yet, when we go into the bank, everybody says, oh, I need to open up a savings account that's going to pay me nothing and take 72 years for my capital to double. And then obviously the bank's going to want to sell you some mutual funds because they make fees on those. And they'll say, oh, well, you'll make 6%. That's a healthy return. But you have to wait more than a decade for your capital to double. With these two examples, and this is what the bulk of the population does, can you name me one person who has gotten wealthy from following these two strategies right here? Investing in a savings or checking account and investing in mutual funds. You can't, because the wealthy people do not follow the strategy. They know the rule of 72, and they know there are so many better options out there to put their money to work. So let's talk about real estate investing, especially in a large commercial deal. Let's say it's a multifamily syndication. These deals are routinely penciling out between 12 and let's say 18%, but I know for a fact that many of these deals, they're underwritten conservatively and they're paying out more than in excess of 20% IRR. So that's internal rate of return. We won't get into that. We've done videos on IRR before. So let's say 17%. And I think that's quite fair, and not to mention all the tax benefits and all that stuff. So at 17%, so you take 72 divided by 17, that's going to give us 4 years and a bit. Well, let's just call it 4 years. So you see the big difference, and this is where this becomes, this makes such a dramatic impact on somebody's lifestyle once they start recognizing these opportunities. You invest in the bank, you deposit your money in the bank. It's going to take you 72 years to double your capital. In a mutual fund sold by the bank, it's going to take you 12 years to double your capital. But then you start using your money, put it to work in a solid piece of real estate with a good value add plan, seasoned management. Your capital doubles in 4 years. Where would you rather be? Sitting, growing a beard, playing euchre at night when you're 72? Or would you rather have your capital double every 4 years? Well, when I speak with many wealthy people on my podcast, Purchase to Profits, and especially many other successful real estate investors, this is how the world's wealthiest people are putting their money to work. They're doubling their capital every 4 years. Imagine the difference on your lifestyle. Imagine the difference on your life, in the most basic level. But by switching your thinking from doubling your capital every 72 years to doubling your capital every 4 years. And let's go back to the example I was using with the paying off your mortgage. We'll use the rule of 72 to illustrate this example. And if you have any questions about this, just go to callseth.com. I'm always happy to chat about real estate investing and talk about your real estate investing goals and some of the stuff we're working on right now. So I had the couple right here, and they're paying off their mortgage. Let's say it's at 3%, right? They're working so hard. At 3%, they are slaving away to pay off this mortgage at 3%, using the rule of 72. How long at 3, if their money was just sitting there collecting 3%, so this is what they're fighting for, the 3%, 72 divided by 3, so that's going to be 24. 24 years, that is a quarter of a century. It's going to take their capital to double. So this is why I get so fired up, and this is why it is so scary once you start recognizing how capital and multiplying your capital starts working, especially in these real estate deals. So many people are stuck, and they're waiting so long. They're waiting a lifetime to have their capital get put to work. Meanwhile, there's a small percentage of people who know about returns, who know about the rule of 72. They know about putting their money to work aggressively, and not to mention the tax benefits, the strong cash flow, all that stuff that goes into it as well. This, the 1% in the bank, the 6% in the mutual fund, this is not how the wealthiest people are creating wealth and multiplying it. They are multiplying their capital. They are doubling their capital every 4 years using these large multifamily real estate investments. And it doesn't have to be multifamily. It can be an industrial deal. It can be retail. It can be office. But the main thing is, they are putting their money to work in a vehicle that will produce those results and double their capital in a much shorter time frame than, 72, 74 years, something like that. So to me, that is just craziness, and it's very, very scary to me. So I hope this really helps. Just remember the rule of 72. You just take 72 divided by the rate of return that you are expecting, or that you are returning, or that's being returned to you. And that's going to give you the number of years that it's going to take for your capital to double. Try it out with some of your current investments right now if you have mutual funds, and make sure you're sitting down when you do it because it will be an unpleasant surprise. So I hope you enjoyed this. I don't think I got too worked up. Have a great night. And if you do have questions or if you think real estate investing sounds pretty good, head on over to callseth.com. Thanks a lot. Have a great night.